Good morning, welcome to the FIIG Securities Expert Series webinar. My name's Elizabeth Moran, I'm Director of Education and Research at FIIG, and today we're delighted to have Ernie Chang, Tax Partner from PwC, join us. Before I hand over to Ernie, just a couple of housekeeping points. You'll see on the right-hand side of your screen an orange arrow. If that isn't expanded, you can click on that and then you'll see a panel. Midway down that panel there is an area that you can ask us questions. So while we're giving you the webinar, please type in any questions you've got. We do have a number of questions already from clients who sent them in pre the webinar, and we'll try and address those first. But if you could make your questions fairly short and to the point, that would help us today. So without further ado, I'm going to hand over to Ernie. Thanks very much for joining us. I hope you enjoy the webinar.
Thanks very much, Liz. Thanks for the introduction. I'm delighted to be here. My name's Ernie Chang. I'm a corporate tax partner with PwC Australia, and I'm absolutely delighted to be here and happy to field any questions that you may have. I will, however, just stress that I am a financial services tax partner. I specialise in providing advice to financial institutions and on financial products. I am not an expert on superannuation, whilst I'm happy to take some general comments on superannuation and in particular how financial products may be taxed in the hands of the superannuation fund. I will try and stay clear of areas outside of my expertise, for example, areas such as pension asset tests, etc. So without further ado, this is just a quick overview of the agenda. I would like to briefly cover the current tax landscape. I have some personal views, and certainly PwC as a firm have some views in terms of the current state of political and social climate around taxation, and in particular the tax reform agenda. And also I'll touch upon some potential relevant changes that might be on the horizon. Secondly, I'll briefly go over some superannuation tips, particularly with 30 June on the horizon. Again, stressing that I have had the benefit of expert guidance from some of my superannuation partners. And then lastly, and really the main part of this webinar, some tax overview of financial products, and in particular, any particular questions that you may have in that regard.
Great, thanks Ernie.
The current tax landscape. I won't apologise for the fact that this is a little bit editorial, and I think it's the nature of the beast in a lot of respects. I think we are all very much aware of the current political climate. You just have to look at the last federal budget to understand that both the Prime Minister and the Treasurer are under a reasonable amount of pressure, and they're paying particular close regard to opinion polls. When the most exciting thing to come out of the latest federal budget was the $20,000 write-off for small business, you can see that there's not a lot of will there for substantive tax reform currently. Now that might change very quickly, and certainly we expect to see some further movements in that regard in terms of the lead up to the next election. But as we currently sit, I think appetite at the federal level for substantive tax reform, I think, is somewhat lacking. Having said that, the general social climate for tax reform, I think, is gaining an ever-increasing impetus. In my 25-year professional life, I have never seen so many references to tax and tax reform in the financial presses, and not only the financial presses, just the ordinary newspapers and media. I think every second article talks about potential changes to imputation, and you have a whole bunch of people coming out for and against. Negative gearing, again, a whole bunch of people coming out for and against, and clearly the one that's most dear to your hearts, changes to the treatment of superannuation. In addition to that, you have the whole overlay of the global focus on tax, and specifically corporate tax avoidance. There's been a lot of noise around the Googles, the Apples and the Starbucks of the world, the mention of a Google tax, some measures of which we have seen alluded to in the federal budget. That's outside the scope of today, so I won't go into those in detail. But the whole area of transparency, whether multinationals are paying their fair share of tax, and in turn the impact that may have on the overall tax take, together with a revisit of the impact of indirect taxes such as GST, stamp duty, and the whole basis upon which the federal government and the states share their tax revenue under the revised federation agenda, is ever moving, and I expect to see substantive changes in the years ahead, but as I said previously, probably not on the current political agenda. So that's tax reform in a nutshell, and I can only urge you to obviously pay attention. It will be a primary focus of the government, of media, and of social commentators in the weeks and months ahead, and watch this space. Now, in terms of relevant changes, clearly superannuation is an area that all sides of politics are focused on. The Prime Minister has come out and have ruled out changes to superannuation. That is not consistent with the Labor agenda, nor is it consistent with the superannuation industry itself. How that plays out will be fascinating. I think there is clearly a case to be mounted that politically you can fine-tune certain changes, but whether those are cosmetic only, whether they only attack the so-called high net worth individuals, and if so, what is the actual balance between the actual revenue that's raised versus the increased administrative complexity against a backdrop of whether it is only for political show. I'll leave you to form your own views. My personal view is I think a balance needs to be struck. I think there is a certain perception out there in the community that superannuation is not fair as it's currently in its current legislative and regulatory context. But as to how you actually fix that and balance fairness, the raising of revenue, and administrative complexity, that is actually not an easy problem to solve.
Interesting, thanks Ernie. I'm watching the media all the time. There's so many different commentators with their views on where superannuation's going. It will be fascinating to watch, I agree.
Okay, so superannuation tips. And some of these are, motherhood, but I think given that we are very much fast approaching 30 June, I think a general reminder never hurts. Contribution limits, and particularly having regard to the particular age of the individual. If you have turned 50 during the year, it's gone up from 30,000 to 35,000. So, revisit your contribution limits, look at how much you've put in, speak to your financial advisor or accountant if need be. It is still a concessional treatment of taxation, and to the extent that you can make those contributions, generally speaking, obviously subject to your own financial situations, but generally speaking, I think you may well find it beneficial. So, seek advice if you need to revisit those limits. But I stress, those contributions must be received by the fund. Okay, so it's not enough to mail your check out. Obviously, direct transfer, that's most efficient, but please ensure that your contributions are actually received by the fund. Lots of clients in the past have been caught out, so if you are going to do it, then please cross the T's and dot the I. Also, in terms of if some of you are in pension mode, look at the minimum pension payments that are required to be made by 30 June. Again, superannuation area is, we have seen lots of hiccups over the years with excess contributions and the like. We have enjoyed some administrative concessions from the ATO, but increasingly it's an area that is complex, and if you get it wrong, you cannot always rely on or guarantee that the tax office will be lenient. Some of the more broader superannuation tips. In-house assets is one that a lot of people need to be concerned with, and in particular because the downside is so big. I mean, the consequences can be so draconian. As many of you are aware, if you breach the in-house assets, subject to an exercise of discretion by the Commissioner, you basically blow up your superannuation fund. The value of the assets are subject to tax at the top marginal rate. That can be incredibly painful. And as I said, you cannot always rely on the leniency of the Australian Tax Office. So dealings with related unlisted unit trusts is one that a lot of taxpayers can trip over. You know, be very mindful in terms of whether you or your associate can be regarded as controlling that unit trust. And if so, then please get expert advice. The ability to borrow, I think that is in a state of flux. I think the government has clearly flagged that they will be revisiting this. There's no concrete changes that I'm aware of that have been announced, and I think it is very much, you know, watch this space. Having said that, against the backdrop of potential legislative change, you need to be very mindful of the ever-changing administrative practice around such loans. So the Tax Office in recent times have come out and pretty much indicated that those loans need to be on arm's length terms. That has changed. When these rules were first enacted and the Tax Office were administrating it, I don't think they really focused on the terms of the loans, but increasingly, and we have seen public rulings and also a number of private rulings that Tax Office has issued, they do very much expect those loans to be now on arm's length terms. So that pretty much has exhausted my superannuation expert. So I think, Liz, unless you had anything specific in that regard, I'll move on to more sort of general taxation.
There's two quick questions I'll just ask Ernie. One from Chris. He says, does a receipt via fund include a cheque in the hands of the trustee as at the 30th of the 6th?
Yes, it would, as long as you get an acknowledgement of that. So, because, you know, how would you know that that has been received? If you just simply posted it, yes, in theory, as long as the fund has received it in hand, it doesn't need to have been banked and certainly doesn't need to have been cleared, but the question is, how do you know?
Right. Yeah, right. And one from David here. Can a non-concessional contribution to super be made from post-tax company profit?
Ooh, I'm just thinking whether I know. So look, I have to apologise. The answer will be caveated because I'm not entirely sure of the full aspects of the question. I believe so, because non-concessionary is pretty much contributions that may be made after post-tax dollars. The reason why I'm hesitating is the question alludes to post-tax from company profits. And so you have an overlay whereby the contribution is coming from another entity apart from an individual. Okay, so given that, and given I don't know the particular circumstances of the company, is it a private company, is it a public company, are you an employer, are you a director, again I would, so my initial reaction is yes, you can, but whether there are additional consequences, whether they be fringe benefits tax or otherwise, then I think you should get advice in that regard.
Okay, Richard's come through. Company is a private company. Anyway, whether you want to comment further or leave it at that. We'll probably take another question, actually.
Yeah, I'll probably prefer to leave it, Liz, that's okay.
No, it's getting very technical here, and I know that's not your specialty. Sophie asks, and I hope I get this question right, if I have an employer contributory super and would like to salary sacrifice to self-managed super fund, shall I have to subtract the productivity component from the $35,000 limit? Not sure. Not sure.
Okay. Sorry. I mean, these questions really are quite specific superannuation questions. I mean, maybe what this demonstrates, Liz, is we should organise another one of these, and I'll introduce you to one of my superannuation partners.
That sounds great, Ernie. Let's move on then. Let's keep going.
Okay. Liz, was there a general question on traditional securities and how that's taxed?
Yes, there was. So Jill asked, assuming that corporate bonds offered by FIIG are traditional securities, are profits on sale fully taxable? that is not subject to the capital gains tax rules and therefore can only be offset by losses on bond sales, not losses on share sales?
The short answer is yes, but I will unpack that a little bit more because there's quite a few issues that's raised by that. So first of all, consistent with the slide that you see before you, in terms of overview of TOFA and how that interacts with traditional securities, maybe a quick recap would be helpful. And Liz, correct me if I'm wrong, I mean, this is all generally set out in the guide, that FIIG is published, and obviously, you know, investors do have access to that guide.
Yes, and I should have said that up front. My apology, Ernie. For those of you that have been clients with FIIG for a number of years, you would know about the Australian Guide to Fixed Income, which we published in 2013. There is a specific chapter in there dedicated to tax, which Ernie drafted, and we're very grateful for. So we can make that available after the webinar, but certainly if you have a dealer, or they could actually send it to you as well. So that we do have tax on security set out in that chapter, but it's great to have the author here himself today. So
yeah, so you know, please feel free to read that at your leisure, and it does cover some of this overview in greater detail. But for present purposes, the overview, traditional securities are really instruments, and for the most part they're probably bonds, but instruments which essentially pay a yield, and they're not expected either because they were issued at a discount or you purchased at a discount, or there is some kind of additional component at the end of the instrument that you expect an additional return over and above your original principal. Okay, so that's a traditional security. By contrast, a qualifying security, and I'll explain how that interacts with TOFA in a moment, a qualifying security is an instrument which, over and above the annual yield that you would ordinarily expect to receive, would also incorporate an additional return, again, either by reference to a yield to maturity in the context of a discounted or a zero coupon bond, or in terms of some kind of indexation factor or some other kind of additional return that may be present with the bond, that additional return is material enough to take it outside of the sphere of traditional security. Now, just going back to answering the question, there is specific tax legislation which governs the taxation of traditional securities, and it is correct that gains on traditional securities, which, if you think about what I said in the overview, is not really expected or intended at the time that the bond was originally issued, because ordinarily traditional securities you do only expect to get the principal back. But in the event that a gain or profit does arise upon sale or maturity, then under the specific tax provisions governing traditional securities, it will be taxed as ordinary income. And the assumption in the question, albeit it's not clearly articulated, but the assumption in the question is that the loss on the shares is on capital account. Now, clearly, depending on your individual circumstances, shares can be on revenue account, such that some taxpayers, be it individuals or companies, but not necessarily superannuation funds, because superannuation funds generally hold all of their assets on capital account, but certainly for individuals and other taxpayers, it is possible to have shares also on revenue account. But I think implicit in the question itself is the assumption that the loss on the shares are on capital account, and therefore you cannot offset capital losses against revenue profits. You can only offset capital losses against capital profits.
Great. There's another couple of questions I've got here. Neil asks, what happens to the premium paid on bonds if you pay a premium up front, so you pay more than the $100 up front, and you hold the investment to maturity? Is that a capital loss, and can that be amortized and claimed as a deduction over the course of the period of the bond until maturity? Does that make sense?
It does. Wow, that is again a multifaceted question.
Yes. Because
it depends on the bond. Is the bond a traditional security? Is it a qualifying security and subject to TOFA? So I'll try and answer this, but mindful that we haven't quite had the opportunity to dive into TOFA as yet, but I'll try and answer the question. So maybe if I just go back one step and just reflect on, in what circumstances would you pay a premium? Because if it were otherwise a traditional security, that is, there's no kicker or other return over and above the yield, why would you pay a premium? Well, you probably pay a premium because, for example, and this is not exclusive, it might be a fixed interest bond. The yield is very attractive, interest rates have gone down, therefore the value of the bond has gone up. And so if you're buying in the secondary market, you'll pay a premium for it. Now, that doesn't necessarily change the fact that it's still a traditional security, because you're still not expecting additional material return over and above the annual yield. It's just that the annual yield is so attractive that you're prepared to pay a premium to get your hands on the bond. So in that example, the annual yield will continue to be fully taxable. And so what's lying at the heart of your question is, have you converted capital into income? Because instead of paying $100 for a $100 bond, you're paying $110, for example, but you're getting a higher yield on which you're fully taxable. So what happens to that $10 at the end? Now, the reason why it's a multifaceted question is, in turn, it depends on how it's disposed of. So, for example, if you sell it, okay, under traditional securities, it is generally treated on revenue account. So if you make a loss and you trade it on the secondary market, it can be a revenue loss. However, there's always an exception to the exception, and there's an exception in the traditional security rules whereby in certain circumstances, and in particular, if one of the reasons you are getting rid of the bond is because you have concerns about the liquidity or solvency of the issuer, then that revenue loss can be deemed to be a capital loss in those circumstances. But if in the ordinary course, if you just happen to be trading on the secondary market because, for example, interest rates have now gone back up, the yield's not as attractive, so the value of the bond has gone down, and so you bought it for 110, you're now selling it for 105, and you simply sell it for that basis, that $5 loss in that really simple example should be a revenue loss.
That's fascinating. I didn't know that. So if you buy a bond in good faith and pay more than the par at first purchase, and something happens to the company, say there's a major event or there's a downturn in commodity prices, and then you have concern over the credit, and you then sell, then at that time it could be deemed as a capital
Yeah, there's
loss.
a specific provision in the traditional securities which sets that out and deems what could otherwise be a revenue loss to be a capital loss.
I've learned something, and that's valuable. Thanks very much. I'm going to let you keep talking on the presentation. We have got a number of questions here, but let's talk about TOFA, and then we can ask some more in-depth questions.
And I think that's good because this will flesh out some of the general principles around TOFA, and that might preempt or help answer some of the subsequent questions. So the slide immediately in front of you now, you'll see a quick overview of TOFA. Now TOFA, taxation of financial arrangements. This was introduced about 4 or 5 years ago, and a bit of context. The gestation period was well over 20 years, and the main drivers of taxation of financial arrangements were the banks, because they would deal with billions of dollars of financial arrangements every day, and for them to go through every single financial arrangement and to ensure that the tax treatment was 100% accurate was an administrative and compliance nightmare. And to be perfectly honest with you, most of them didn't. It was just too difficult. And whereas for accounting and regulatory purposes, there was a different regime. For example, accounting would mark to market and they would recognize unrealized gains and losses, but often for tax purposes, they would not be able to be recognized. And to sort through, billions of dollars of transactions, that was just too hard. So they've been lobbying for TOFA for 20 years. So we finally got it. And for the banks, that's fantastic. They can elect into TOFA. There are a whole bunch of other elections that they can choose, one of which, providing they qualify and their accounting reports are up to scratch, which for all of the large banks you would expect to, they can actually adopt to align tax with accounting. They can actually rely on their financial reports to replicate the tax treatment of their financial arrangements. So, fantastic. But in the absence of that, TOFA is incredibly complex. Now, when the rules first came out, we very merrily thought, well, TOFA should apply to the banks and to the big end of town, and if you're a corporate with, hundreds of millions of dollars of bonds on issue or very complicated swaps, etc., well, you can get your own advice. What finally came out wasn't that friendly, because even though it applied a reasonably high threshold for TOFA, generally speaking, so in particular there's one which looks at superannuation funds, and for a superannuation fund to ordinarily to be subject to TOFA, you need assets of at least $100 million. There is an exception to that, as there always is, and the exception is if a particular financial arrangement is greater than 12 months and is a qualifying security, then you are subject to TOFA, and that's whether you're an individual or a self-managed superannuation fund. Right? I've expressed it in the negative in the slide, but let me phrase it more in the sort of positive, if I could call it that. You don't have to worry about TOFA unless it's greater than 12 months and a qualifying security. Okay? Or in other words, if the security is greater than 12 months and it's a qualifying security, you have to worry about TOFA. So that's two different ways of looking at it.
Okay. So just while we're talking about the 12-month thing, Mercy had a question, and is there any relevance for tax purposes to hold bonds for 12 months or more? Does that tie into the 12 months?
Yes, yes. Yeah, and the answer is possibly. Well, sorry, I beg your pardon. The answer is yes, there will be implications, but exactly what sort of implications, again, if you think about it, if it's a traditional security, then not so much, because again, for a traditional security, you're really more worried about the running yield and how that's taxed. But if it's a qualifying security, i.e. there's a return materially over and above the annual coupons, then having something that's over 12 months will bring you into TOFA.
Right.
What does that mean? Hence, that brings us very nicely to this slide. What does being subject to TOFA mean? Well, I think the technical and the strict answer is not in a good place, because well,
all right, big red flag here.
Yes, because the rules are very complex, and even for a large corporate, you often have conversations with corporates whereby you explain how TOFA works, and then you add a caveat whereby, yeah, but practically a lot of people do this, or practically a lot of people do that, and they say, okay, great, that's what we'll do as well. And so, you know, technically, if you ever want to get advice and do it properly, it'll cost you a lot of money. But practically, a lot of corporates will simply adopt accounting, even though they may not be in the same position as the banks and having the ability to elect into the financial reports election that I alluded to earlier, or they will simply do a very simple accrue methodology, which may not be in strict accordance with the accrual provisions in the TOFA legislation itself, but near enough is good enough. Yeah. You know, in terms of the cost-benefit analysis, you know, is the tax office really going to have a go at you, etc., etc. Not that I'm advocating not meeting your obligations to apply tax law strictly. I'm just giving you a practical overview. Okay, but in terms of what is meant by accruals versus realization, so where you have returns on a TOFA instrument, which are, and the phrase that's used in the legislation is sufficiently certain. Okay, so if the returns are sufficiently certain, then you are technically obliged to apply the accruals basis. And the accruals basis, crudely speaking, is because the returns are sufficiently certain, you kind of know what they are in nominal terms, you add them up. So you add up not only the coupons, but you might add up to a premium or maturity or the discount, you add them all up. You do a discounted compounding basis, which can itself be extremely complicated.
I'm just thinking I'm not going to ask you for the maths behind this.
No. And I'm not sure I could actually explain it very coherently either. But you then add it all up, you apply a discounted compounding basis, and then you accrue that over the life of the instrument on the basis that it's compounding at least once a year. Okay?
It makes sense.
And for people who invest in zero coupon bonds, they'll more readily understand it, because that's how you kind of work out the yield to redemption for a zero coupon bond. That you notionally assume that, you know, if you were to get coupons along the way and they were compounding every 6 months or every annually, but this is the lump sum that you get at the end. What's your running yield?
Yes.
So it's that kind of concept, right?
So I should just point out for the listeners, those who don't know zero coupon bonds, you buy the bonds at a big discount, and you actually never pay any income. You just get the $100 back at maturity, but each year the value of the bond increases. So you're not actually getting anything in your hand, but there is an accrual, if you like.
Yeah. So a really simple example. Let's say it's $100 on maturity, but it's discounted on day one at $60, and it's a 5-year. I'm not going to get the interest rate right, but let's say you buy it for $60, you hold it till maturity, and at the end of 5 years you get $100. Okay, that $40 is your return, obviously. Now that's economically not that different to paying $60 for something and then holding it for 5 years and getting $60 back as principal, but along the way you've received interest of $40. Yes. Okay, so economically the two are equivalent.
Yes.
Okay, but to work out the yield, so if you buy 60 and you get $40 worth of interest either every 6 months or every year for the next 5 years, you can work out pretty easily what your yield is. Mm-hmm. So the concept behind discounting the $100 face value back to the $60 for a zero coupon bond works on a similar basis, albeit in reverse.
Yes, great. Thank you.
Now, where you so the contrast between accruals and realization on the TOFA is where you cannot do the accruals determination, either because the returns are not sufficiently certain or because the terms of the bond are such that there could be variable returns, etc., then TOFA allows you to essentially recognize your return on a realized basis, i.e. as and when received. Now, what does that mean for your typical bond? And actually, maybe I won't go into that now because my last slide does talk about 2 or 3 different instruments which are
Yes.
generally invested in. So maybe I'll leave it there. Yeah. So that's a general overview as to the difference between accruals and realization on the TOFA. And then the balancing adjustments, as the term suggests, it's reasonably straightforward, which is if that accrual, for whatever reason, does not align fully with what you expected, because don't forget, the phrase is sufficiently certain. It's not guaranteed, and obviously there are blips and things might change along the way. Then there's a balancing adjustment whereby you kind of add up all your returns that you have actually received, you compare that to what you've accrued to date, and to the extent there's a positive or negative, you make an adjustment, and that adjustment will be assessable or deductible under the TOFA regimes.
Annie, we're getting a lot of questions about capital index bonds, the inflation-linked bonds and the treatment of those. Do you want to handle those now? Do you want to wait towards for the end?
Yeah, probably the end.
Okay.
As I said, my final slide goes through examples of different bonds, and that's one of them.
Okay.
So,
well, let's keep going
yep.
then, and we will get to your questions. Hopefully, Ernie will answer them before I even have to pose them. So you'll be doing my work for me. That'll be done.
Well, we're almost there. Right. I mean, in terms of the overview, I'm up to the last point, and then we can sort of jump to the last slide, and then obviously take further questions if that's okay, Liz.
Fantastic. That's great.
Okay. So the last slide's foreign exchange implications, and we did get some questions prior to the webinar from people around foreign exchange. Now, again, let me preface my comments by saying I'll tell you what the requirements are under the law, and to the extent that you can implement it practically, or people are using some other basis which gives them a reasonably similar result, shall we say, then that practically may suffice in many instances. So both under the traditional securities and the TOFA rules, it's predicated on calculating your return in the foreign currency first, and then converting that return into Australian dollars at the applicable rate. Now, what does that mean? So let's say you buy a US corporate bond for US $100. Okay, Actually, no, better example, zero coupon. That's actually probably a better example. So let's say you buy a US corporate zero coupon bond for US $60, and then in 5 years' time, at maturity, you receive $100 in return. Okay, what you're really required to do under TOFA is that return is sufficiently certain in US dollar terms, namely $40 US. You then convert that $40 US on an accruals basis, and then you apply the exchange rate applicable each year. Okay, and the ATO publishes average exchange rates for every year. So, for 30 June 2015, if you go on the ATO website, they'll have an average exchange rate. So you use that average exchange rate to convert the accrual of that share of the US $40 that you've accrued for the 2015 year. Now, you don't have to use the ATO exchange rate. I mean, I know people sort of play games and they go and look at the Bloomberg rate and they look at the RBA rate, and the Tax Act doesn't say you have to use the ATO rate, but for what it's worth, the ATO does publish a rate. Okay, but you can use sort of those other rates. So that's a very easy example of what you're supposed to do under TOFA. Similarly, for traditional securities, if you buy a traditional security, so you buy a $100 US corporate bond, it pays annual interest, and then end of 5 years, you get your principal back, $100. The good news is, unlike the old days, where you kind of had to convert the 100 US into $8 on day one, and then you convert $100 US dollars into $8 in year 5, and you've got to compare the two, and that may give rise to an FX gain or loss. Under the new rules now, because you have to work out that gain or loss first in US dollars, in the traditional security case, there is no gain or loss on the principal in US dollars.
Interesting.
Right, for tax.
For tax.
Now, economically, you may be exposed to foreign exchange fluctuations, clearly, because if it was parity on day one and you've used $100 Aussie, and in year 5, the $8 is worth 110, say, well, then you're getting less $8, right? So that's a commercial foreign exchange exposure, but not tax, right? For tax, it's $100 minus 100, zero. You're converting 0 into $8, therefore 0. Okay. Whether you choose to hedge your foreign exchange exposure from a commercial viewpoint, obviously take your own advice. Okay?
So that commercial loss at maturity, if you like, that doesn't help you in your tax or contribute to tax in any way.
No.
Great. That's a really interesting point. Another point I've learned today. Fantastic.
And then just finishing off the traditional security example, the coupons along the way. So unlike TOFA, remember the TOFA example I gave you, because you were working out your accrual for the year, I stated that you should use the average rate, the average FX rate during the year.
Yes.
Coupons on traditional securities are probably different because most listeners are probably treating interest on a cash basis. That is, they bring to account cash interest that they receive in any particular year, right? As opposed to accruing for interest like a corporate would, right?
Right.
Because most listeners here would be bringing to account the interest received on a cash basis, then the Tax Act does give them the ability to use the spot rate for the cash that's received on a particular day.
Great.
Okay, so if it's a quarterly coupon and you receive it 31 March, 30 June, 30 September, 31 December, you do have the ability to, again, go into the ATO website or go to the RBA website and they'll give you an exchange rate for the day.
Depends on the size of your portfolio, I'd say.
Depends on the size of your portfolio.
Yes.
That's right.
Could be huge.
Yeah.
A lot of work in that.
Okay, so that's pretty much the overview. Now, and we'll probably repeat some of the overview stuff in the context of specific examples, and again, we've covered some of these already. So to the extent we have, then maybe I'll skip over it. But
I don't think it hurts to reiterate it, and I don't know about the rest of the listeners. I always like to hear it in a slightly different way and seems to sink in better for me.
That's fine.
So, we'll let you run with it.
That's fine, Liz. But if you find I start contradicting myself, please pick me up.
I promise.
Hopefully I'll be consistent. So corporate retail bonds, look, yeah, again, read your FIIG guide in terms of a general description of what they are. But you know, they're reasonably vanilla. They're usually, you know, they're typically you invest $100, you get back $100. Certainly for the Aussies, it's $100 Aussie. Yeah, and apart from potentially buying or selling the secondary market, which you know we alluded to earlier in terms of the premium, and I'm happy to go through that again. They would typically be traditional securities. You would get a running yield, which may be paid monthly, quarterly, annually, as the case may be, and you would bring that to account, the interest to account in your tax return in the year in which the interest is received, i.e. on a cash basis, as I previously outlined. Any gain or losses on the traditional security, either when it's redeemed because the company's sort of gone belly up, or if you sell in the secondary market, typically they would be on revenue account, subject to that proviso that I mentioned earlier about an exception for a loss on a traditional security if one of the circumstances is you sold it on the basis of a concern that you know the company may not be liquid or solvent. To the extent that you are able to buy bonds either at a discount or a premium, then it is a little bit complicated because then you've got to overlay and reconcile the traditional security rules with the TOFA rules. Because remembering what I said, the traditional security rules are predicated that your return over and above your annual coupons are not material. Okay, so if you happen to be lucky enough to buy a bond at a discount, and that discount is material, and materiality, again, there's a formula in the Tax Act. It's pretty much 1.5% discount, but if you I think it's 1.5% per annum discount. Okay. But if you're lucky enough to buy that at a greater discount, so that it's material, then it may take you out of the traditional security provisions into the qualifying security provisions, and therefore, if it's over 12 months, into the TOFA rules.
Great. Okay.
So does that clarify the difference between corporate retail bonds, how they work, if you simply buy and hold on issue as opposed to buying the secondary market, etc.?
Yeah, it does for me. I didn't know what that material rate was, and the 1.5% per year to maturity gives you a good, you know, well, that's the guide. So I didn't know that. That does clarify it. So if you're lucky to buy enough to buy, as some of our clients were, Swiss Re bonds a few years ago for $80 or $75, and the maturity or expected call date, which was maturity, was you know, the amount you expected to earn in the $100 was more than that 1.5% rate, then you're into TOFA. So
and the period to maturity is greater than 12 months.
Yes, sorry, it was definitely greater than 12 months of habit. That's a good qualification too. So. Yeah.
Okay. Now, zero coupon bonds, I'm not sure I need to say much more. We've covered it both in terms of general concepts, foreign exchange. So
I don't think so. I don't think too many of our clients actually hold zero coupon bonds. They're an interesting instrument, and I think we should, you know, possibly sell more of them. Yeah. But no, I think we're good on that one. Okay. The index annuity bonds, the capital index, and you know, they're I think what most people are really interested in because it's that treatment of inflation and the different securities, how they're treated.
Yeah.
So.
Now, you might need to help me a little bit here. So can I maybe set out my understanding of how they work and the particular profile of these financial instruments?
Yes.
You correct me if I get it wrong before I talk about the tax. So my understanding of inflation index bonds, is it only the coupons that are indexed for inflation, or is it the principal that's also indexed as well?
So there's two types, okay? So the first type is what we call the capital index bond, so issued at $100 or par, and then every quarter inflation is added to the face value. So the capital grows, the interest or the coupon is fixed on that growing capital basis.
Right.
So it does, increase with inflation over time, but it's
not the coupons.
No.
It's not the coupons that are directly indexed to inflation.
No.
They are indirectly indexed because they are fixed by reference to a principal sum, which is increasing by reference to the
That's
inflation
exactly
index.
right. That's
okay.
exactly right. Let's deal with those ones first,
Okay.
and we'll talk about the other ones
okay.
in a minute.
All right, understand. Okay. Well, and sorry, before I answer the question, so is it only the interest, the fixed interest, which will increase because it is now calculated by reference to an increasing principal, or is it the case at the maturity of the bond you also receive that greater capital index principal?
That's exactly right. So the capital of the capital index bonds grows over time, many, many years, 20, 30 years, so that in 20 or 30 years, the $100 bond that you bought first issue may return you $180, and that includes inflation over a longer period. So it's treatment of that accrual, I think, that people are particularly interested in.
So really you're getting a higher coupon as well as a higher principal on redemption.
You are,
okay.
yes,
All right.
you are.
Okay. Well, okay. All right. So it sounds like a qualifying security. So again, thinking back to the definition of qualifying security, the qualifying security is if the return, aggregate return over the original $100, over and above the annual coupons, is material, i.e. over and above the 1.5%, then that's a qualifying security and not a traditional security. Okay. Now, obviously, it depends a little bit on inflation.
Yes, yes.
But in the ordinary course, and historically in Australia, you know, we're not Europe, so
No.
historically, inflation is going to be more than 1.5%. And so my expectation would be that capital index bond would be a qualifying security and therefore subject to TOFA.
Okay.
Okay.
Yeah.
So that's the threshold question.
Yes.
Then the next question is, okay, how do you account for it? Do you account for it on accruals or on a realisation basis? I have to then dive into technicalities a little bit.
Yes.
Remembering I said that the phrase that's used is sufficiently certain.
Yes.
Okay. Now, what that does is it asks you a couple of things. Firstly, it asks you to look at that in nominal terms.
Yes.
But secondly, it also does this. Because if you had to predict on day one that all returns under a particular instrument had to be absolutely certain in nominal terms, you would rule out a whole bunch of instruments that they wanted to catch. Variable interest, inflation indexed, things that are linked to a particular index, like a SPY index or whatever. And because they fluctuate, you know, variable interest fluctuates, right? Which means that if you read that provision literally, all of those instruments would then fall out of the accruals method and only be under realisation. And that's not what they wanted to do. So they added a specific requirement to say, if the only reason for the variability is by reference to something, which is measured by an objective benchmark, then it will still be subject to accruals. But what you're then required to do is make an assumption that that thing doesn't change over time in working out what your aggregate nominal return is on day one. You work out your accruals basis and then you do your balancing adjustments along the way. So let me illustrate what that means in plain English. So,
right, that's right. I'm looking forward to this.
So let's say the index is CPI.
Yes.
Or bank bills, LIBOR, or the SPY index, right? They are all things, I'm trying to use deliberately neutral terms, they are things which can fluctuate but can be measured by reference to an objective benchmark of some kind. CPI, SPI, LIBOR, BBSW, right, all of that, okay? So the legislation presupposes that those things of themselves should not allow taxpayers to take you out of the accruals regime and into the realisation regime. We want you to stay in the accruals regime, okay? And how we do that is, let's say the inflation rate when you acquire the bond was 3%, you assume it'll be 3% the rest of the life of the instrument. and you use that to work out what your nominal return is. So in the capital index, you assume that's going to be 3%, so 100 goes to 103, 103 goes to 103 point whatever. Your fixed return, let's call it 5%. So first year will be 5% of 100, second year will be 5% of 103, third year will be 5% of 103 point something, right? And you work out your nominal return based on that assumption that that index is 3% on day one and doesn't changes.
At the very beginning.
At the very beginning. That then gives you your aggregate nominal return, and then you apply the discounted compound yield to maturity based on that. And then you accrue that over the term, right? Now, I told you at the outset, TOFA is bloody complicated, right? So that's how complex it is.
Yes.
Do you expect individuals and the smaller self-managed superannuation funds to be able to comply with that in practice? Boy, pretty hard, right?
Really hard, and really hard. The sort of the mathematical modelling and the maths that you would need behind that, no, I can't imagine that they would.
Yeah. But technically, that is what you're required to do under TOFA.
Okay. That's tough.
That is tough.
That's tough. So obviously there's different ways that people treat it, and in practical purpose.
Yeah.
And I guess the overarching thing for me from the webinar today is to get advice and get someone else to help you with it, because we both agree it's tough.
It's tough. So look, I have to be a little bit careful here, Liz. I can't tell you to ignore the law, right? But I can maybe give you some guidance on what other people do, and whether it's, in the event the ATO were to come in and say, hey, you're not doing a strict compliance, but you say, well, we've been doing this, and sort of best endeavours, and depending on how the particular ATO auditor feels, when you have penalties and interest, that's kind of in the laps of the gods a little bit, right? So, I can't give you definitive advice. I certainly can't give you definitive technical advice different to what I've already set out would be the strict requirements of the legislation. Okay. But if you think about what the bookends are, okay, so one bookend is strict compliance, along the lines of what
you've just outlined.
The other bookend is head in sand, right? So that bookend is, I'm just going to ignore the capital index component. I'll just recognise the coupons in my tax return, acknowledging the coupons are increasing, right? So it's 5% of 100 in one year, first year, 5% of 103 next year. So they're increasing, and I'm bringing the right income to account along the way, but I'm ignoring the capital index. Well, they're the two bookends, right? And that second bookend, I'm not sure the ATO would be totally sympathetic, because in your example, if your 100 is grown to 180, and on a yield to redemption, that 80 should have been, under my technical bookend, been brought to accruals along the way, and you've enjoyed this deferral for how long? 5 years, 10 years, 20 years? Could you rely on the ATO being sympathetic to that? I'm not sure you can.
No.
You might.
You wouldn't want to. You wouldn't want to take that chance,
right?
I don't think.
Over 80 years, a material amount. Okay. So they're the two bookends. So what's a practical compromise?
Yes.
One practical compromise, and I'm not suggesting it's the only, and I'm not suggesting that will be necessarily acceptable to the ATO in all circumstances, but one practical compromise is, what about if you also included the $3? Okay, so 100's grown to 103. That 3, under my strict compliance model, would have needed to be added to, you would have, in that really simple example, you would have needed to accrue that 80 over the term, right? 100's grown to 180, in our simple example. You would have had to accrue that 80, right?
Yes.
So, as a practical proxy for that, one alternative is just to recognise the additional 3, right? So in year 1, it's 5% of 100, so it's $5. In year 2, the 100's grown to 103, and the 5% of 100 is now grown to, what's 5% of 103? $5.20 or something, I don't know, right? So it is a reasonable proxy in year 1 to recognise $5, and in year 2 to recognise $8.20, which is the sum of the $5.20 and the 3.
That sounds reasonable to me.
I'm not guaranteeing
No,
that
no,
would be
and
acceptable.
you can't, because that's not
But
the...
that is a proxy which could be presented to the ATO as reasonable.
Sounds good to me. Sounds good to me. Okay. The other type of inflation-linked bond is one where investors pay a lump sum, and then the company returns principal and interest quarterly linked to inflation. Like there's a base payment that is linked to inflation, so that over time the amount invested is returned entirely to the investor.
So it amortises to nil.
Amortises to nil at maturity. So that's the other sort of inflation-linked bond.
Okay. And so what's been inflated? The $100 on day one. It's just that as you amortise it, it's not. Sorry, I'm just trying to fully understand it, Liz, before I answer the tax side of things. So let's say it's $100 and it amortises to zero over 10 years. Now, as we know, it's not 10, 10, 10, 10, 10, but you know, for the financial literates amongst this is rule of 78. So you go, rule of 78 sort of presupposes amortising principal, where in year one it's mostly interest and little principal, and then that sort of reverses over time.
Exactly.
So in year 10, it's it's a little bit of interest and mostly principal, right? So what gets indexed in performing that profile? It's the $100 that gets indexed in performing that profile. So if I could maybe ask it another way, Liz, if ignoring indexation, if the profile of that over time would be such that you've received 150 over 10 years.
Yes.
Right? So it's $50 worth of interest, but it's 150 over 10 years.
Yes.
And look, just to keep it a really simple example, it's $15 a year for 10 years.
Yes.
But obviously in year one, it's mostly interest, a little bit of principal. But in year 10 of the $15, it's mostly principal and a little bit of interest, but you've received $50 of interest over the term.
That's right.
With an indexed bond like that, with the indexation, let's say in aggregate, the 150 becomes 180.
Yes.
Would the profile be, in my really simple example, sort of like, actually I'm going to answer my own question. The profile is unlikely to be $18 a year over 10 years, or could it be? Or is it more likely to be, I'm kind of struggling to be, what I'm trying to understand is, with the $150 example,
yes,
actually maybe it doesn't matter. Maybe it doesn't matter. What I was going to ask, Liz, was with my 150 example, ignoring indexation, $15 a year over 10 years, in aggregate you get 150, it's still very obvious that 100 of that is the return of your original principal, albeit over 10 years, and $50 of that is your return, albeit over 10 years. And what I was going to ask was, assuming the index bond profile gives you an aggregate of 180, and you get $18 a year, you know, is 10 of it the original principal, is 3 of it referable to the indexation benefit, and is 5 of it referable to your normal coupon? And I've kind of answered my own question, because I don't think it matters, because whether of the 18, you know, 5 is original and 3 is index, or it's 6 and 2 and whatever, for tax purposes, the 8 is still over and above your 10, right? I.e., your 80 is still over and above your 100, irrespective of how your 80 is broken up into annual interest and the sort of capital index component of it.
That makes it really easy.
Yeah. In which case, it's the 80, right? It's the 80 the return, and if you're subject to TOFA, again, you're supposed to bring to account the 80. And because that is your return over and above the 100.
Great. That makes it really simple, because I was thinking that would be quite a complicated, long-winded. But that makes it really. I think you've simplified that, and that seems like a fair
that's where I started.
Well.
That's where I started. But thinking through it, I'm not sure it matters.
No.
Because as I said, whether it's 5 and 3 or 6 and 2 or 7 and 1, the whole 8, it's still an accretion over the 100 and under TOFA will be taxable. It's just the profile, and it's whether you do, the two bookends or you do the sort of practical compromise in the middle that I just previously outlined in the first example.
Okay. I think that's great, and I'm hoping that's answered a lot of questions. I am going to run through some more questions, but there's one I did want to ask, and I thought it was a really good one that we had pre the webinar, and it was from Greg, and he wanted Ernie to summarise the tax consequences where an investor disposes of the bond prior to maturity, the different types of bonds. So perhaps would you like to have a go at doing that, Ernie? We'll start maybe with the fixed and floating, the corporate bond, and then down to those two different inflation ones.
Okay. I mean, it is a good question because I think it does pull together a lot of the strands that we've been talking about. The underlying context, though, is still the overview. What sort of bond are we talking about? Is it a traditional security? Is it qualifying security? Have you been accruing along the way? What have you been doing? Have you been head in sand, ignoring the 3%? Have you been doing it properly? Have you been practically, doing the 3%? So let's start.
Yes. Corporate
Corporate retail bond. As I said at the outset, your typical corporate retail bond is a traditional security because you invest in 100, you get back 100. So let's start with that.
Okay.
Now, if you were to sell early, then we've kind of addressed this already. If you sell for 100, no gain, no loss, no harm, no foul.
Mm-hmm.
Okay.
Mm-hmm.
If you sell for a profit, you sell for 110, then that $10 is assessable at that time.
Mm-hmm.
If you sell it for a loss, if you sell it for 90, generally speaking, that $10 should be deductible, subject to that exception that I outlined previously.
Mm-hmm.
That's it. Pretty straightforward.
Okay. Yep.
If you bought it for anything other than 100, depending on whether the discount has been such that you have brought yourself into the qualifying security, right? So I'll come to that in a moment. But assuming you haven't, so you've been lucky and you've bought it for 98, right?
Yes.
Not a huge discount.
No.
And you hold it and you sell it for 100 or $2 gain. You sell it for 102, $4 gain. You sell it for 95, $3 loss. Same.
Great.
If you bought it at such a discount that you brought yourself into the qualifying securities and therefore TOFA, so let's get on to that next, then depending on what you've done, and here we're talking about corporate bonds, so we don't have to worry about the indexation, we don't have to worry about the zero coupon, so typically, even if you're a qualifying security, what you really should have been doing is accruing the discount. So if you've been lucky to buy at a discount large enough to bring into qualifying security, you should have been accruing that.
Okay.
Okay. And again, there are the three. There's the two bookends. First bookend, you do it technically right.
Yes.
Discount, yield to maturity compounded. Head in sand, so you just ignore that discount and you just bring to account. Or third, is there a reasonable proxy? Now that reasonable proxy is maybe more difficult because there's not an indexation number you can just grab, like our capital index example, right? There's not a 3% you can just grab.
And I guess if you're selling something, it's because it's made in a higher loss or higher gain, higher gain than you expected. There's a reason for the sale where you wouldn't not have necessarily expected the higher return or the loss.
No, but Liz, if you think about it, if you've been lucky enough to buy it at a significant discount,
yes. Oh, so you still would have that expectation.
You should have been accruing it. You
yes.
should have been accruing it, right? But there is not an easy practical proxy like the indexation number that you just plonk in. You almost, without getting out a scientific calculator, even a practical proxy probably means, look, I've been fortunate enough to buy a bond which was issued for $100 for 80, right? I'm going to hold it to maturity or sell it for 100. You should have been accruing that 20 using some kind of practical methodology, right?
Right. Yes. Yes. Yep.
Okay. If you haven't, then you've either been doing it properly or you've
head
in sand.
Okay. Good. So does that then apply as well for the other two bonds, the capital index ones? Similar, same,
yeah,
same
similar. And same for the zero coupon as well.
Yeah.
I mean, zero coupon, as you rightly pointed out earlier, because by nature of zero coupon, as it gets closer to maturity, you pay 60 for a zero coupon bond, which will pay you 100 in 5 years' time. As you get closer to the year 5, economically that it should creep closer ever close to 100, right? So instead of paying 60, you might be paying 70 or 80 or 85, but you should still be accruing the difference between the 100 and whatever you pay for it.
Okay.
Now, the question talks about sale, so it's not necessarily holding to maturity. So you may not necessarily get the 100 in all of these examples that we're talking about.
No.
But then that brings in the balancing adjustment. And so for additional security, you're simply comparing what you paid and what you sell. Easy. And for accruals and TOFA, you're comparing to your actual return to what you've accrued. And whether that's been on the basis of head in the sand, technically correct, or the practical proxy, you still add up what you've been accruing and you compare to what your ultimate return is, including what you've ultimately sold it for.
Yes.
And then at that time, there's a balancing amount. And you recognise that balancing amount in the year that arises.
Okay, I understand that. I'm hoping all of our listeners do as well. I am going to run my eyes through the questions now. I have one question though while I'm doing that. What happens if the unthinkable happens and a company goes into wind-up? How, say it goes into wind-up and you get back 40 cents in your dollar, so 40%. How is that treated for your tax purposes?
And there was a case on this some years ago, and unfortunately, I think the law is such that that would probably be caught by the exception to the revenue loss in the traditional securities provisions that I outlined. From memory, the case was a Harris Scarf bond.
Okay, all right.
Yeah, and we know what happened to Harris Scarf.
We do.
And yes, and it was litigated. You know, the bondholder argued that it should have been a revenue loss. The tax office disagreed, and I think that the court agreed with the tax office. It fell within that exception, and it was a capital loss.
It was a capital loss.
Yeah, under that exception.
So, okay, fantastic. Because I wasn't sure if there was ever that reason, but yes, capital loss. So you could then put that off against share gains, or if it happened in the same year.
But not other income gains.
Not other income gains.
Yeah.
Fascinating. That's great to be quoted a legal case and have that precedence. So we've got some other questions here, and I'm going to try and I hope you can answer some of them. Stan asks, and this is a complicated question, Australians would normally be considered non-resident aliens by the IRS.
Oh, right.
How does this sound?
Yep.
Does holding a US dollar bond expose one's estate to estate tax on the death of a holder? Do not answer it if you do not want to. I think it's an interesting question.
It's an interesting question, but it's a question more on US tax.
Okay, yes, right? Good point.
It's a US tax question, and again, you know, I have other partners who are qualified to answer the question on US tax. Unfortunately, I am not.
That's fine. That's absolutely fine. It's hard to actually just disseminate the questions from what we've already talked about, because I feel like we've talked about a whole lot of the cases that would arise. There is one here. Again, this may not suit you. There is Anthony is in the process of setting up a self-managed super fund after the 1st of July, and he wants to transfer his corporate bond portfolio currently held in his personal name into his self-managed super fund. How does the ATO treat the assets transferred as a sale from one entity to another? Like, would he be subject to capital gains tax, and does he have to obtain a market price on the transfer?
The short answer is yes.
Okay.
And again, it raises a couple of different issues that we've covered. You know, you talk about capital gains tax, but as we've already covered, you know, a lot of these bonds aren't on capital account because they're either traditional securities or TOFA, or it's actually on revenue account. So I'll cover both for Anthony's benefit. Certainly, if we were talking about a capital gains tax asset, you know, like a house or shares or a painting or whatever it is, then there are specific deemed market value substitution rules under the capital gains tax rules. Okay, so the answer is yes in terms of the CGT rules. But for these bonds, they're typically not capital gains tax assets for the reasons that I've just outlined. Nonetheless, they have their own arm's length rules in terms of parties not dealing at arm's length, both in the traditional security provisions and in the TOFA provisions. So the short answer is yes, you should get a market value transfer. That's the price that you should apply. that will give rise to a gain or loss, or maybe no gain or loss in your personal name in terms of your disposal to your super fund. That will then also give a market value basis for the particular instrument in your super fund going forward.
Great, Ernie. I think that's probably the end of the questions. There are more here. I'm hoping we've answered them for you today. If we haven't, or you're still a little bit uncertain, that chapter in the guide does list out exactly the qualifying securities. It talks about TOFA. It gives different scenarios for sale and purchases of bonds. So I'm hoping that will cover any questions you might have remaining. I just want to thank you so much for coming today. I've learned quite a lot, and I'm going to go back and listen to the webinar again and take some notes. So I can't thank you enough for joining us here today, Ernie. It's great to have such expertise and to be able to hear firsthand from a tax expert. So thank you very much for joining us.
My pleasure, Liz.
And thank you to all of you for dialing in. I hope you found it useful. We will send you all a link to the recording after we've finished, and look out for our next Expert Series webinar. Thank you very much. Have a good afternoon. This now concludes the presentation.